Okay, good afternoon and welcome back everyone to our intermediate options master course. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're going to embark on our journey to start our second course, which is the intermediate options master course. And we're going to be talking about part one, which is entering options orders and managing existing positions. So we're going to go through a lot of things for both beginners as well as for those of you that are currently trading. This is the next step in our options education. I hope many of you that are here today were able to join us last Monday for our virtual options education day. We were really excited to host that event. We had a spectacular turnout. More than 1,100 of you showed up, participated, saw a bunch of speakers talk about the markets and talk about how we trade the markets. I hope that many of you were able to join us. For those of you that were not able to join us for that fantastic event, I will show you here in a couple of minutes how to access the recordings so that you can see what we covered. But that event was meant to help sum up everything that we covered in the first two beginners options master courses. Now, all of this is recorded, everything from the first master course, second master course, as well as the options education day was recorded. So I highly recommend, for those of you that are new to options trading, that are still in the learning process, even if you're experienced in options trading and you want to brush up on your education, I highly recommend you take the time to go back and take a look at the fantastic education that has been recorded and available to all of you here utilizing Options Play. So today we're going to embark on our second step of our journey. Now that we've finished the beginner courses, now let's start talking about a little bit more advanced options strategies. We're going to talk about everything from managing orders to selecting expiration dates and strike prices to getting into more complex strategies like debit and credit spreads, and also talk about some of the things like volatility and Greeks. So for those of you that have some more experience, getting into the more advanced topics is what we're going to cover in both the intermediate, and then eventually we're going to get into the advanced courses. We're going to keep doing these options education days because of how successful the first one is. So again, thank you so much for everyone for participating. You guys are a big part in us continuing to do this for everyone in Canada. So let's go ahead and get started here. Before I do, just a quick disclaimer. Any examples that I give today is purely for demonstration purposes and is not a recommendation or solicitation to buy or sell any specific securities. Now, for those of you that joined us during the Options Education Day, or you're already a member of Options Play, you're probably familiar with how to access the tools. But for those of you that are brand new, maybe you just joined us, you have access to a free platform called Options Play, which gives you access to the tools as well as all Canadian securities on those tools, courtesy of the Montreal Exchange. You can access it using the link I just posted into the chat window. This gives you access not only to the platforms, but the options education webinars like the one you are on today, the free on-demand video library, which includes all of the previous courses, as well as the Options Education Day, weekly cover call and short put reports to help you generate income on your portfolio, and a variety of other things that we provide that are all available to you free of charge, simply for signing up using that link on your screen. So let's go ahead and talk about what we're going to cover here. So today we're going to focus predominantly on two things. Number one, we want to talk about entering and exiting positions through your order types. So understanding how to enter a position, how to exit a position, because that's first and foremost in terms of before you start executing strategies in your portfolio, is knowing how to enter them, where do you want to place them, thinking about liquidity. Then what we'll talk about are managing your positions. Well, once you're in a position, how do you close it? How do you manage it? When do you decide you get out of it? When do you decide to hold on to a trade? So those are some of the things we're going to discuss here today. Now, again, for those of you that missed our Options Education Day, again, we covered five different speakers spoke, and we covered a variety of topics to show you how to get access to how professionals utilize options in our portfolio. So you can actually see those recordings using the link on your screen, which again, I just posted it into the chat window. So those are things we're going to go over here today. And I hope that for those of you that are new to us, you will be able to take some time to review the education that we have created to help catch you up to where we currently stand. Now, one of the things I do want to say is that I want to provide an educational experience that is aligned with the viewers here. So before I start talking about everything, I just want to do a quick poll. If everyone could please just answer the poll that's on your screen. What is your experience level with options trading? Are you just learning? Do you have some experience trading? Are you experienced already? I just want to get a sense for the audience here in the room before we embark on this intermediate course. Okay, so I see a pretty close to an even 50-50 split between those of you that are learning how to trade options and those of you that are experienced, almost exactly a 50-50 split. So 50% of you say you're just in the process of learning. Some of you have experience trading. And then for those of you that are experienced, I think that you might find the first part of this course a little bit basic, but hopefully you'll learn something about liquidity and entering your orders, because I do think that's very important. For those of you that are beginners, I really hope that this inspires you and helps you understand some of the basics as far as, once you have a strategy in mind, how do you go about entering that order into your brokerage firm? How do you think about where do you place those orders? And then at the very end, we're going to talk about managing positions. Now, for those of you that are brand new and you're just learning, you may not, the managing positions may not be as applicable, but as you go through the learning process, as you start executing positions in your account, these are the things that you want to start thinking about as far as how do you maintain a position in your portfolio? So those are the things that we're going to go over here today. So let's first start off by talking about entering an options order. Now, before we even talk about an options trade, we need to first establish a couple of things. Number one, because we're trading an option, which is a derivative on a stock or an ETF, we must first establish what we call a directional view on the actual stock or ETF. So you can be bullish on the stock, you could be bearish on the stock, or you think the stock is just going to go sideways. Regardless what your views are, you have to first establish that view, because once you establish that view, that's going to help you select your option strategy. So if for certain strategies, if you're bullish on the stock, there are certain strategies that make sense there. If you're bearish on the stock, there are other strategies. And if you're neutral, there are certain strategies. So as you go through the learning process, you'll learn the different strategies and how they're applicable to different outlooks. But you have to first select that outlook, which helps you determine which option strategy you want to utilize. These are some of the things that we covered during our options education day. These are some of the things we covered in our beginners master course. And these are some things we're going to continue to cover in our intermediate options course. Once you have an option strategy, then we're going to talk about, then you have to select an expiration date and strike price. This is actually something we're going to be covering on our next course. We're going to talk a little bit about how do you go about selecting expiration dates and strike prices from an overarching perspective, so that you, regardless of what strategy you use, regardless of how experienced or inexperienced you are, you have a general sense of where should you start doing your research when it comes to expirations and strike prices. Now, once you have all of that, once you have a strategy, once you have an expiration date and a strike price, now it's time to enter your order. Now, the difference between a stock and a options order is that in a stock order, you don't have to specify whether you are opening a position or closing a position, meaning you can either just buy the stock and sell the stock later, and your brokerage firm effectively, or the clearing firm effectively, automatically figures out that the buy order is to open, and when you sell later, they'll figure it out that it's to close. With an option order, you have to actually specify whether you're opening or closing that transaction. So in a stock transaction, you can either buy and establish a long position, or you can sell to establish a short position. And once you execute the corresponding opposite order, it automatically closes it for you. So you don't have to specify that, oh, I'm buying right now, so that's an enter order, and I'm selling later, so that's closing order, or vice versa. If you sold the stock first short and then bought it back later, the clearing firm effectively figures out which one's the open, which one's the closing transaction. When you're trading an option, you actually have to specify whether you are opening a transaction. So on an entry order, you must always specify that your order is to open. Now you can place this order either with a limit or a market order. Now that works the same way as your stock position, meaning you can specify a specific price at which you want to be filled on, or you can specify a market order which prioritizes execution speed, meaning you want to be executed on that. You don't necessarily care as much as far as the price. You just want to make sure that you are in or out on that specific trade. So those are the things that you need to establish when you're entering a position. Now, there are some things that we need to discuss about exiting, but we're actually going to discuss those far more in a few minutes. But you should always think about, before you enter a position, what your exit strategy is. So whenever you're thinking about buying a position, you should always consider, where do you want to cut losses if the expected move does not materialize? Meaning, if you're bullish on a stock and instead of the stock moving higher, the stock moves lower, where do you cut your losses? Where do you say, I'm wrong, let me move on to the next trade? And you should always have rules for both cutting losses and taking profits. So regardless of whether a trade goes against you or in your favor, that you have rules pre-established before getting into your entry order to either take profit or cut losses. That is very important in terms of trading options or trading any market, to be perfectly honest, but especially with options, knowing when you want to cut your losses and when you want to take profits before you get into a trade. Now, does this all make sense to everyone? Before I move on, please type 1 into the chat window, which you can pull up at the bottom of your screen. Okay, perfect. I see a lot of ones. Great. So just for a quick example, in order to buy or sell a specific options, we'll have something like this. Normally with the stock order, you just have to specify buy or sell. With an options order, you have to specify buy to open or sell to open. So you can either buy, meaning you want to establish a long position to open, or you can sell to open, which is effectively establishing a short position on that option. So I see a couple of questions in here, and I will answer that in terms of what's an ideal profit percentage. Those are some things we're going to discuss because it really depends on the option strategy. So now that we've talked about entering an order, now let's talk about closing orders. So when you enter a to open order, the corresponding closing transaction will always be a to close order. So when you can enter, you can either buy to open to establish a long position. In this particular case, either a long call or put, or you can establish a sell to open, which is effectively a short position on a call or a put. Now, depending on which one you first enter the position in, you must make sure that you use the corresponding closing order in order to get out. So if you buy to get out, you would have to sell, but you can't just sell. You have to specify sell to close. So if by accident you enter the order by using a buy to open order, and then to close it, instead of selling to close, you accidentally close it with a sell to open, what will end up happening is you will effectively be both long and short that position at the same time. Now, that doesn't actually close out your transaction. Granted, your P&L will be hedged between the two positions, but you have to consider the fact that by having two open positions, you may have different margin requirements each one, and you're going to have to hold the margin requirement on both of those in order to establish this position. So in order to close this position, once you buy to open, you must make sure that you sell to close. And if you sold to open first, you must make sure that to close that position, you need a buy to close. So an example of an order is to buy to open in this particular case, a BMO June 2020 $66 call for $5.50. This is an example of a buy to open order. Now, to close this, you would simply have to sell a sell to close order to close the existing position. Does that make sense? Please type 2 into the chat window if that makes sense to you, that you must use the corresponding to close order. And if you don't use the to close order, what will end up happening is you will end up having two open positions instead of closing your original position, which is not something you want to do. Okay, perfect. So how do you do an order entry from options play? One of the things about options play is the fact that on our platform, regardless of what strategy you're looking at, you can always click on the trade button and we will show you the strategy that you can utilize to enter into your broker's platform. So especially for those of you that are beginners, 50% of you said that you're still learning, meaning you might not have placed your first trade. Placing that first trade many times can be daunting because when you're trading options, there are far more things that you have to worry about. You have to figure out what symbol, you have to figure out what action, the quantity, the expiration date, the strike price, the type of the option, whether it's a call or a put, and the premium. So you have 1, 2, 3, 4, 5, 6, 7 different fields that you need to worry about when you're placing an options trade. So far more things to think about when you're placing that options trade, which also means that there's a few more possibilities of entering this trade incorrectly, right? You could potentially flip buy to sell, or maybe to close instead of to open, or maybe get the wrong expiration date or the wrong strike price or the wrong call put or the wrong premium. That has happened to traders. So it's important that you have a tool like options play that guides you to exactly each one of those parameters and make sure that you are entering those correctly. Very important that you know how to access that, again, by clicking on the trade button within the options play tool, so that no matter what strategy you're analyzing, once you've found the strategy you're looking for, hit the trade button and we will show you how to enter that order, especially when you get into some of the multi-leg orders. So for those of you that do like to trade more complex trades, when you click on the trade button, it will give you the legs, all the different legs, because once you get into the more complex strategies, even 2 legs, you're looking at 12 different data points that you need to worry about. So if you're selling a call vertical, a credit spread, there are quite a few different things that you need to account for. So make sure that you utilize the tool correctly by clicking on the trade button, and we'll provide you with the details on how to enter this trade into your broker's platform. So make sure that you utilize that tool. Now, and this is just an example of the screen that I just showed you, and I think it's better to see it on the platform than here in this particular screenshot. So now let's talk a little bit about closing positions. So let's say you take all those steps to enter a position, whether you're buying a call option or you're sold a cover call. When it comes to closing your positions, this is really where it varies by broker to broker. So that's why I can't provide you with a screenshot, because each broker is a little different. But effectively, most brokers, how you go about selecting or closing a position is you typically go to your positions tab within your broker's platform. And what you can do is you can select your current options position from your portfolio. And usually there's an option for you to close position. So if you have a bunch of positions on your portfolio page, you might have 4 or 5 different positions, and maybe one of them is an option. What you generally should have is the ability to select a strategy and basically have an option here to close that position. And what that should do from your broker's perspective is it should automatically bring up an order where it has the things filled to close, automatically filled for you. Now, again, this varies from broker to broker, but generally speaking, this is the process that we typically see, is that you can go through a list of your positions, check off the one you're looking for, and select close. And that should automatically pre-fill an order ticket with to close already pre-filled for you, because it's designed to prevent you from opening up a new position as opposed to closing it. And it should automatically select buy or sell for you based on whether this is a long or short position. Because if you have a long position, it should be a sell to close. If it's a short position, then it should automatically fill a buy to close order for you. Now, for those of you that are brand new to options trading, if you're a first-time trader, I highly recommend that when you're placing your first order, call your broker, have them walk you through your first trade. Most of these discount brokers have customer support that you can call. They should be able to help you, walk you through placing an order in terms of opening transactions, as well as show you how to take an existing position in your portfolio and how to close it out. But again, most brokerage firms allow you to select a position that you have, and there should be an option to close, okay? So now let's talk a little bit about options liquidity, because this is really where it does impact your orders. And especially I see a lot of beginners do not have the right information to decide whether or not an option is liquid or not, and they don't have access to the tools to understand how to go about determining liquidity. So one of the things that I want to show you is that when you go outside of the top 20 to 30 names in terms of liquidity, in terms of market cap. So think about the big market cap names in Canada. You have your financials, you have your energy stocks, perhaps a few mining stocks. You know, the cannabis stocks, even though it's very liquid, it's very popular, they're generally speaking smaller cap names. You have a couple of telecom names, but that's about it in terms of Canada, in terms of what I would consider big cap names, right? So anything below that, what we generally tend to find is that you'll see lower open interest in terms of options volume. You'll see generally wider bid-ask spreads. So this many times deters a lot of investors from trading options on them, is when they see that the options have low open interest or that they have very wide bid-ask spreads. But the one thing that I want to remind you is that the liquidity of an option is really just a factor of the liquidity of the stock. So if you think about whether you believe a stock is liquid or not, if you think that the stock is liquid, chances are the options are just as liquid. So many times what we tend to find is that the options may not look liquid, but there's plenty of liquidity that sometimes is not very apparent. So most orders we tend to find are filled within 5 to 10 cents around the midpoint. So you can have something that might be trading 50 cents wide, but you can place an order 5 cents away from the midpoint and still get executed. And for those of you that are brand new and you're saying, what's a midpoint? Don't worry, we're going to go through that here in 1 second. But what I'm trying to say here is that don't be afraid to place orders inside the bid and ask spread. We're going to go over that here again in 1 minute as to what that actually means. But for those of you that are experienced, many times you might see something that's trading, let's say $1 by, let's say $1.60, and you're saying to yourself, wow, that's a really wide spread, that's 60 cents wide. That's effectively, here, let's say the midpoint here is $1.30. So you got 30 cents to go on either side of this particular trade. Now, this might look like a very wide spread, but what we tend to find is that if you look at executions, they tend to happen within a fairly narrow range, maybe $1.25 to the downside and maybe $1.35 to the upside. So even though these are quoted very wide, right, out here, these are quoted very wide, but the actual executions actually happen in a much narrower range. And that's really what we're concerned about, is not how wide something was quoted, but how wide the actual executions are. Now, I will say that generally speaking, the wider the quote, the wider the executions, but the quote width does not necessarily represent where you're actually going to get filled. Just the wider the quote, the less liquid something is, but just because it's wide does not mean that you can't get filled inside the spread. So I want to make sure everyone understands that. Now, I will say up to this point, I'm only expecting those of you that have some experience trading to understand this at this point. So for those of you that have traded options, please type yes into the chat window if this makes sense to you. Okay, perfect. Let me see if I just want to pull up. I just want to pull up this spreadsheet that we have created for Canadians, which I will show you how to access this sheet here in 1 second. But just to give you a sense for the liquidity. So what we have created is a liquidity tracker for Canadian symbols so that you can get a sense for what are the most liquid symbols. As you can see, there are 29 of what we would consider very liquid symbols in Canada at the moment. Names that you're probably familiar with, like Royal Bank of Canada, BMO, XIU, TD, Barracks Gold, SU, Enbridge. You know, these are the names. Well, weed also makes the top because weed simply is a very widely traded, but I think weed is the only one out of the marijuana stocks that makes the very liquid names. And then you have what I would consider somewhat liquid names, where you start getting into some of the smaller cap names like Thomson Reuters, Franco-Nevada, the mining stock, so in total, I see about 74 what I would consider liquid symbols that I would trade here in Canada. If you find that you want to trade a symbol that's not on this list, that means that the bid-ask spreads are pretty wide, and that means that you should be very careful when you're placing your orders, and be very careful while placing your orders near the midpoint of that price. So I will send you a link as to how to access that list, but that list is something we now publish in Canada so that you can get a sense for which symbols are most liquid. So for those of you that are brand new, and for those of you that said, what the hell is a midpoint? Let's discuss that here for 1 second. So with any options or with any tradable instrument, you always have two prices, right? Whether you're trading a stock, a future, Forex, options, all financial instruments have two prices. There's a bid price, whoops, there is a bid price, and there is a ask price. Ask price is the price that you have to pay to buy it, is the way to think about this, and the bid price is a price that you would have to pay to sell it. So the asking price is really what someone's willing to sell to you. The bid price is something what someone is willing to buy from you. So every single asset has two prices, an asking price and a bid price, and the mid price is what we consider the middle between the two. And we usually use the mid price as the average between the bid and the ask, and that gives us kind of a average, if you will. So when you're talking about fairly large cap stocks, so if you think about Royal Bank of Canada like we have here, these are large cap stocks. Let me do this. If you think about names like Royal Bank of Canada, BMO, TD, these are big cap names, large cap names that are generally less volatile, will have very smaller bid-ask prices, meaning it's more competitive. There are more buyers and sellers, so the spread between the lowest asking price and the highest bid price usually is fairly tight. So let's say you have an option that's trading at 775 by 795. That is effectively 10 cents away from the midpoint on both sides. So for you to buy or sell, if you bought and sold immediately at the exact same price without things moving, you would lose 20 cents here on this specific trade before things moved around. Now, if you trade something that's a smaller cap name, that's much more volatile, which if you look at this particular list, something that's further down the list, they're going to have much wider bid-ask spreads, because if something doesn't trade as often, you're not going to get as many competitive limit orders out there. So the lowest asking price versus the highest bid price is going to be a further deviation here. In this particular case, you have a $1.30, $1.20 difference here between the mid price, between the bid price and the asking price. So these have a much larger spread, meaning it'll cost you more to transact. Now, again, just because you have a quoted price here that's $1.20 wide on both sides does not mean that that's what you'll actually end up having to pay. But the larger the width, the less liquid a name generally is. And that's what we use to determine whether an option is liquid or not. We look at how wide the bid-ask spreads are. We look at the open interest of that option. We don't look at open interest of a specific option. We look at open interest of the whole chain, because sometimes you might have things that are certain options have a lot of open interest, the other ones don't. Just because a specific option does not have open interest does not mean that it's any less liquid. That is also another, I think, misunderstood part of options trading. You know, I tend to find that a lot of traders, that when they're looking at the option chain, they tend to pick options that have high open interest and prioritize trading those versus the options that have low open interest. How many of you feel that way? Please type yes into the chat window, that when you're trading options, you tend to find ones with higher open interest. Type yes into the chat window if you generally tend to do that. Okay, great. So I'm glad that a lot of you have said yes, because this, I think, is a great moment to teach. So let's just look at the May options. So this is BMO, right? This is the BMO May options. These are all the May options here. May 8th, sorry, May 8th. And if you look at it, the open interest column here for calls sits right here, and the open interest for puts sits right here. So let's see. I want to look for something that has either high open interest. So let's say the May 73.5 calls have 110. On the put side, the May 65s have a lot of high open interest on the puts. We also have the May 68 puts that have 56 contracts, and let's say the May 72.5s. Okay, so these are some contracts that have a lot of open interest compared to the other ones, versus the 71.5 has 0 open interest. Maybe here I'll do this. I'll make this a different color here to make it a little bit more obvious. So this one has 0 open interest. This one has 0 open interest. This one has 0 open interest. So we have plenty up here with 0 open interest. So the ones in red have high open interest. The ones in green have low open interest. So let me ask you, are the 72.5s or 73.5s more liquid than the 71.5s? If you think yes, please type yes in the chat window. If you think no, please type no into the chat window. So are the 72.5s more liquid than the 71s? Okay, so I see a lot of answers, yeses and nos. The answer is no. There's no difference in liquidity between the 71.5 and the 72.5. Even if this had 1,000 contracts of open interest and this one had 0, they both have the same liquidity. Why? Because the only thing that matters is how liquid the underlying stock is. Because as a market maker, for me to sell you the 73.5 or 71.5 or 70.5, it doesn't matter to me as a market maker which one I sell to you. It doesn't matter how many existing open contracts are out there. None of that matters. The only thing that matters is once I sell to you, how easily can I buy or sell the underlying stock to hedge my risk? That's it. It doesn't matter whether I sold you a 65 strike or a 70 strike. It doesn't really matter whether I sold you a May 8th strike or a May 22nd strike, or May 15th expiration. None of that matters. So this 72 contract has nothing to do with liquidity. And so that's one of the things I want to first explain. When you're trading these options, don't just look for something with high open interest to trade, because that has nothing to do with liquidity. That just means that someone else happens to be trading the 73s more often than the 72s. Now, what you generally will tend to find, especially in the monthly options, is that you find that liquidity tends to pool around the round numbers, and especially the at the monies will always have higher open interest, because guess what? People always tend to trade the at the monies. People tend to trade less of the out of the monies, but they have nothing to do with liquidity, because again, as a market maker, for me, it doesn't matter whether I sell you the $46 call or if I sell you the $76 call. The only thing that matters to me is that after I sold you the call, I have to go and buy the stock to offset my risk. And which strike you bought or sold does not differ as far as how much I have to buy the stock. So keep that in mind. Don't be scared that if you're trying to sell, let's say, a cover call here on BMO, and let's say you determine the best strike for you is the 74.5s, and you see that there's 0 open interest, don't be afraid to place that order. Just because you're the only one trading the 74.5s doesn't mean anything from a liquidity perspective. Right now, if the bid-ask spreads here are really wide, then that's a different story. But you'll notice is that bid-ask spreads don't change from strike to strike. They generally have roughly the same bid-ask strike, regardless of how far you go out of the money. That's because liquidity doesn't really differ from one option to the next. If liquidity really differed from one strike to the next or one expiration to the next, you would see differences in terms of the bid-ask spread. So I hope that that is clear to you, and I know a lot of beginners tend to have this myth that they think that if you are the only open interest that you won't be able to get out. Getting in and out, again, has nothing to do with who else holds that contract. It has to do with whether a market maker can buy or sell the underlying stock. So even if you're the only open interest on an entire chain, that doesn't prevent the market maker from buying the stock and hedging your closing position. So keep that in mind. I hope that this was clear to everyone, that what you want to look at is the open interest across the entire chain, right? So here, as you can see in BMO, there are tens of thousands of contracts that are open. There's 10,000 here just in June, right? There's, close to 10,000, there is close to 10,000 contracts here just in this June, 70 to 82 strikes. And you can find, there are tens of thousands of contracts. That's the only thing that matters. Now, compare that to a stock. Let's see. Let's find another stock. I'm trying to find a smaller cap stock. Now I don't recognize this particular name. So look at this particular name on the entire option chain. So here, if I look through the entire chain, there's maybe 1,000 contracts in the entire chain. That tells me that this is far less liquid than BMO. But if I'm comparing strikes, is the 18 strike more liquid or less liquid than the $19 strike? Not at all. They are equally liquid regardless of the fact that someone has 1,800 contracts or 0 contracts outstanding, because the market maker doesn't care how many outstanding contracts they are. They only care of what's your new position and what do they need to buy in terms of the underlying stock to hedge that position. So I hope that this provides you with a little bit visibility into how market making works and how liquidity works, and hopefully that alleviates some of your concerns about trading options sometimes. Look at the whole chain. Don't just look at the individual option that you're trying to trade. So now let's talk about entering orders. And Gene, I will come back to answering your question as to why show open interest then. Open interest is not really useful, to be perfectly honest, from my perspective, unless you're looking at the entire aggregate. Per strike, it doesn't really matter that much, at least not to you and I. Now, when we're placing an order to buy, so before we talked about 3 prices, right? A bid price, well, technically there's really only 2 prices. There's a bid price and an ask price. The mid price is really a theoretical value. It's something that we calculate. It's not something that's actually quoted, right? The only 2 quoted prices are the bid price and the ask price. And what we do is we calculate an average from those 2. We calculate a average from those 2 to get to our midpoint. So usually when we think about trading options, there's really 2 things that we can do. We can either create a buy order or we can create a sell order, depending on whether we want to go long or short the option. And it doesn't matter whether we're opening or to close the order. You can either buy or you can sell. Those are your only 2 actions. Now, when you buy, what you have to do is you need to place an order in between the mid price and the asking price. So if you're buying, you always want to be placing your order in between, somewhere between the mid price and the asking price. If you're selling, you want to place your order somewhere in between the mid price and the bid price. So it's important to remember that, because especially if you're brand new, you're thinking, well, these are 2 prices. Where do I place my order? You always want to make sure that you understand that when you're buying an order, you're placing it between the mid price and the asking price. When you're selling, you want to place it between the bid price and the mid price. Now, where do you place that order? That's really where we turn to, I thought I had a slide on that, but I don't. That's where we turn to the midpoint. The midpoint is always our starting point whenever we're placing an order. Doesn't matter if we're buying or selling, but we always want to start at the midpoint and work our way to the asking price, or from the midpoint, working our way to the bid price. So if you're buying, what do you want to do? You want to pay the least possible price, right? Whenever you buy something, you want to buy something for the lowest possible price. Think about when you buy a TV. Do you want to spend $1,000 on a TV, or do you want to wait till it goes on sale for $700? You always want to pay the lower price. That's why when you're buying, you always want to start at the midpoint. So the lower price is the $7.85. And what you want to do is you want to first buy it at $7.85. If your order doesn't get filled, then you might move it up to maybe $7.90. If your order still doesn't get filled, Your worst case price is $7.95. You can think of the $7.95 as the advertised price. Think about like going into a car dealer, and this is the sticker price. This is what someone's put on the sticker. And you know for a fact that other people are willing to buy down here. So guess what? What you do is you start in the middle, right? That's how, think of it as an auction. An option is, a market is really like an auction, right? And these are advertised prices. These are the list price. You can certainly pay the list price if you really want to get in and out right now, but you can also say, I'm not willing to pay that listing price, but I'll offer you $7.85. Do you want to take it or not? Someone could always say no, and your order will sit there and nothing will happen. And then what you can do is you can say, okay, well, I'll pay a little bit more. I'll pay $7.90, right? I won't pay list price, but I'll pay $7.90. And then that becomes another order. And your order will sit there again. And someone will say, well, maybe someone will say, okay, I'll sell it to you for $7.90. And now your order is filled, okay? So that's how options work, and that's how an auctions work. Same thing for when you're selling, right? You have a sticker price. Someone is willing to buy it from you at $7.75, and you say, I want a little bit more. I don't want just $7.75. It's like someone you're selling a used car, and you say, I want $1,000 for the car, and someone says, no, I'll give you $700. You say, well, that's not good enough for me. So what I'll do is I'll say, I'll counter offer. I'll say, I'll sell it to you for $780. And that is an order that now sits out there. So you play around with this, right? There's no harm in placing an order out there and saying, well, I'm willing to get filled somewhere in the midpoint. Like I said, especially with something that's very liquid, start at the midpoint and work your way out little by little. When you're selling, starting at the midpoint, work your way down, okay? So just think of it like an auction. Think of it like buying a used car. You have to negotiate. Don't just pay the sticker price. Now let's talk a little about managing positions. This is really where it depends on the strategy. So I'm going to cover a few different strategies. I'll talk about how to manage each one of those strategies and give you a sense for the general sense for how do you want to think about managing an existing position. I'm going to start with two basic strategies: cover calls and cash secured puts. This is a strategy that most of you have as beginners will start with. So that's why we're starting with the strategy. Now, when you sell a cash secured put, this is a strategy that allows you to acquire stocks at a discount. And the general rule of thumb is that you have to, when you sell a cash secured put, there are two possible outcomes. The put can expire worthless, and this is when you rinse and repeat by selling another put and continue to collect premium, or your put gets exercised, which means that now you own the stock at the strike price minus the premium that you received. From my perspective, when you sell a cash secured put, there really is no management involved, because you sell a put and there are two possible outcomes. Either one of those outcomes you should be comfortable with before you even sell that put, so that you know that either I keep the income and it expires worthless and I get to do it again, or I own the stock at the price that I really want it at, which is the strike price minus the premium that I received. So once you sell your cash secured put, this is really the only option strategy, in my opinion, that doesn't really require you to actively manage, because once you sell the put, you know that there are two possible outcomes, and you should be comfortable with either one of those outcomes at the end of the expiration. When you sell a cover call, this is to generate yield on the assets that you own. So when you sell a cover call, there are three possible outcomes. So you have a stock, let's say it's trading at $100, and maybe you sell the stock at 110 cover call. So basically you own a stock at $100, and you're basically saying, if the stock rallies up to 110, I'll be happy to sell it at 110, and you're going to pay me some premium for it. So let's say you get paid $1 for it. So to sell this cover call. So if the stock rallies up to 110, you make the $10 profit plus the $1 premium that you collected for. So you make a total profit here of $11 on a cover call, versus if you place a limit order at 110, you would only make a $10 profit. So you're making a little bit of extra income, and you're obligating yourself to sell your stock sometime in the future. So with this type of arrangement, you have three possible outcomes. Number one, the stock can go above the strike price. So it goes above 110. What happens is that, generally speaking, you want to hold on to this position until the last week. And within the last week, you now have an option to do two things. You can either exercise, you can have this stock exercise and basically capture your $11 and be done with the stock and move on to the next trade, Or you can say, you know what? I don't want to sell my stock at 110. I want to keep holding on to the stock because I actually think it's going to go to 120 or 130 or somewhere higher. In that particular case, what you want to do is you want to roll your cover call. Now, I'm not going to get into the details of rolling right now because that is for the cover call webinar and the cover call education. This is meant to give you more of a primer as to how to go about managing these positions. The second strategy, the second outcome is the stock moves sideways. So you think the stock's going to go to 110, but instead it just trades sideways. And let's say at expiration, the stock is still at 100. Now the call that you've sold expires worthless, so you keep that $1. And what you do is you sell another cover call. Maybe you sell another 110 call, collect another dollar, and hope that next month the stock rallies up to 110. But regardless, you get the choice at that point as to what you want to do. Lastly, you could sell a cover call and your stock drops. Let's say it goes down to $90. Now what you've done is you've sold the cover call, the stock dropped instead of moving higher. What you can do is you can actually buy back the call that you've sold and actually sell another cover call. In this particular case, now you might want to, instead of selling a 110 call, maybe you might want to sell a 105 or maybe 100 call. But what you do is you want to buy back the call that you've sold and keep the premium that you've collected and try to generate more income on that particular trade. So those are the general outcomes that you might have when you're managing a cover call, a cash secured put, and how to go about managing those strategies. Now, what I want to cover a little bit is managing long calls, because this is a question that someone had earlier today as far as how do you go about managing these trades. So first of all, whenever you're buying an option, so buying a call, buying a put option, or if for those of you that are a bit more experienced in trading debit spreads, whenever you're buying an option, the rule of thumb here is fairly easy. And I say this because buying options, when you're buying a call or a put or a debit spread, the most you can lose is what you've paid, which is what makes the management of these strategies relatively straightforward. When you're selling an option, that's when it gets a little complicated because what you can make is certainly fixed, but what you can lose is not fixed. Which is a little different. It makes risk management a little tricky. It makes managing the positions a little tricky because you don't quite know how much you're risking when you get into the trade. When you're buying an option, you know exactly how much you're willing to, how much you can risk, or how much you can lose, and that's why making it manage the trades are a little easier. So whenever you're buying an option, so long option strategies, or if you're trading anything that's for a debit. Now, this doesn't necessarily just apply to debit spreads, but anything that's a debit, whether it's an iron condor or butterfly, anything that's, or even a straddle, anything that's a debit, you generally want to cut losses when you've lost 50% of the premium that you pay. So again, it doesn't matter whether you bought a call or a spread or a straddle. Let's say you pay $1 for that straddle or call or whatever it is, and that option at some point later declines to, let's say, 50 cents. So something you bought for $1 is now trading at 50 cents. That usually is a good time to tell you that whatever view that you originally had on the stock, whether you think the stock's going to go higher, go lower, go nowhere, whatever the strategy is, right? And there's lots of different strategies that you can trade for debit. If you've lost 50% of the debit, that generally means that whatever your views were, it's probably incorrect, and that you've lost half of the premium that you paid for, and it's time to cut your losses and move on. This way, you don't lose the full dollar. You still have 50 cents left that you can apply to the next trade. You haven't risked 100% of your trade. You generally, whenever you're buying an option, you don't want your option to decay to zero, because once you've decayed to 50 cents, your probability of the option decaying to zero is relatively high, meaning the probability of your stock then getting back to, let's say, $1 is pretty low. And the reason for it is really because of time decay. Time decay is really working against you. So just because you have a decline here does not mean it's equally easy for it to go back. It has a much higher chance of it going down to zero than for it to go back to 1. So whenever something declines 50%, you generally want to cut your losses because you have a much higher probability of it declining to basically 0 and losing the other half of your investment. So you generally never want to double down on a trade and increase your portfolio risk, because we see a lot of times where a stock goes from, or an option that you buy from $1 goes down to 50 cents. And what we see is that people will buy more of this 50-cent option, hoping that what happens is that when you do get that rally back up, you make a profit. But again, by the time that happens, you have a much higher probability that it goes to 0 than for it to recover to 1. So for that reason, you generally never want to double down and increase your portfolio risk. Now, on the flip side, on an option that you bought for $1, if it starts to go in your favor, and again, this applies for most strategies that you pay for a debit for, if it starts to reach $1.75 to $2, so about a 75 to a 100% increase in the option price, then it's time to start taking profits. Now, you don't have to take all the profits off the table at this point. You can take what we call partial profits. What that means is that, let's say you bought, in this particular case, 10 contracts of this option that you paid $1 for. When it reaches that $1.75, what you can do is you can, let's say, sell 5 contracts of it and still keep the remaining 5 that you think perhaps can continue moving higher. But by selling 5 of those contracts, what you do is you take off most of the risk of the entire trade, and what you leave is still another leg of the trade that can make substantially more money if the stock continues to move higher or move lower, depending on which direction you bet on, but doing it in a way that you have virtually 0 risk left on the particular table. And this is really the only time, in our opinion, where it makes sense to roll your positions. You can roll it up or out. That is something that is a little bit more for another discussion here. But the only time it makes sense to roll a position, and I get a lot of questions about rolls, rolls can be done in multiple ways. It can be to close a position, open a new one. It can be closing a partial position and leaving the other half on. There are lots of different ways to do it, but usually you do it because you have to extend the time or the magnitude. So meaning you have an initial move and made the initial move and you think it's going to continue making that move, then you can roll that. A roll is simply a single trade where you're closing out an existing position, and what you're trying to do is you're trying to establish a new position as a result of it. And you're doing it, generally speaking, in a single trade where you're closing out an existing position and establishing a new one in a single trade. That is what we refer to a roll. Now, rolls, again, generally only work when you are profitable on a trade and you think it's going to make more money, and rolls are meant to help you continue that trade but take some risk off the table. And by taking risk off the table, what you're doing is you're really increasing your overall return on the trade eventually if the trade continues to move higher. And I can't speak enough of how many times I see people who roll a trade that's a losing position instead of a winning position. And what this ends up happening is that that's really where you could lose big, because something that you originally didn't go in your favor. So what you're trying to do is you're trying to make back your losses. What you do is you roll that position. Next thing you know, instead of the stock moving higher, it continues to move lower. And now what you've done is you've lost even more money. And now you've lost twice as much money or 3 times more money. So generally speaking, whenever you're rolling, you generally want to avoid rolling when a trade goes in your favor, so that you don't avoid wiping out 2 to 3% of the original investment. You only think about rolling when the trade goes in your favor to reduce your risk. So rolling is really when you're closing an existing open position and you're opening up a new open position and doing it so in a single order. That is what we call a roll. It's nothing more than just a fancy word for closing an existing position and opening up a new one in a single order. A roll is not a strategy. It has nothing to do with the order type. It's just trying to establish 2 trades in one single order. That's it. I get a lot of questions about what a roll is, but that's effectively it. There's nothing else to a roll. So with that, that is the essence of how to go about thinking about options orders, opening them and closing them, how to start thinking about when you want to close a position from a losses perspective as well as from a gains perspective. And I want to cover more with you today, but unfortunately we don't have more time, and I've gotten through as much as I possibly can. But I hope that this was useful for those, especially for those of you that are brand new, that when you're looking at these option chains, I provided a little bit more help for you as far as how do you go about navigating, where to choose. Also, not being afraid to engage with a contract that has zero open interest, especially if you see that across the entire chain there are lots of other contracts that are open, that have open interest. So if you're looking at BMO, you see the full chain, there are thousands and thousands of contracts that are available that are open out there. That means plenty of people are trading this. Don't be afraid to interact with one that just happens to have zero open interest. It really does not matter in terms of liquidity if one strike has zero open interest and the next strike has 2,600 contracts of open interest. So I make sure that I hope that you that makes sense to you. So with that, I'll open this up for Q&A if anyone has any questions. I know there are a lot of questions already, so I will scroll up and try to ask, I will try to answer those questions. But if you have any questions, please type them into the Q&A window. So there's a Q&A window and there's a chat window. Please type them into the Q&A window and I will try to answer your questions in the order there. Now, I want to answer a couple of questions that did come up here. Peter, if you have an issue with verifying, please send us an email at info@optionsplay.com. We'll help you out there. Just not during COVID, BBQs are 2-hour long. I'm not sure what that's referencing. Are you talking US bid ask or CA bid ask? I'm talking about both. I mean, it's applicable to both. Couple of questions regarding how to access a liquidity list. So it's trade.optionsplay.com/CA liquidity. I believe it's CA liquidity. Let me make sure. Nope. Let me get you guys the link here. Yep. So the link to the liquidity list is trade.optionsplay.com/CA liquidity. So I just posted a link into the chat window for those of you that want to access this liquidity list from, for those of you that want to access the liquidity list. Let's see. How about interlisted stocks on both CA and US exchanges, more liquid? So Michael, I've generally found that it depends on which sector. I tend to find that Canadian banks are more liquid on the Canadian exchanges. I also find marijuana stocks that are Canadian listed that are Canadian companies to be more liquid on the Canadian side. There just seems to be a lot more trading volume on Canadian exchanges for those. The other types of names like mining stocks, I do tend to find that you might have more liquidity or smaller bid-ask spreads on the US exchanges. But again, bid-ask spreads many times I think are misleading. And I think those of you that correct me that it was $1.70 wide instead of $1.20 wide, you're absolutely right. I only trade stocks with 3 strikes over 100 open interests each. So I think that's a fairly common thing that I see all the time is someone will tell me that I only trade an option that has at least this amount of open interest. Again, the open interest of each individual strike doesn't mean anything because a market maker doesn't care what strike they're selling or buying at. They only care that the underlying stock that they need to buy eventually after selling or buying the call or put from you is liquid. Because I don't care that if I sold you the 65 strike or 69.5 strike, I have to buy the stock to offset my risk. And the only thing that matters is how liquid is the underlying stock. As long as I can trade the underlying stock in and out, it doesn't matter to me as a market maker which strike that I sell. So again, I hope that makes sense to you. So don't be afraid to, if you see that there's lots of open interest on the option chain, don't be afraid to trade a contract that has zero open interest. And again, Preet is asking a question that I think many investors have. There's no open interest. Who will be willing to buy? A market maker. A market maker doesn't care how many existing open contracts are. Their job is to buy and sell from you. They're the ones that quote these bid-ask prices. They're the ones that are providing a two-way quote. That's why there's both a bid and an ask price, because someone is always willing to buy or sell at these prices. So a market maker is the person on the other side, and a market maker does not care how many existing open contracts there are on a strike when they're quoting you this price on your screen. Can you explain volume? Volume is just simply how many contracts were traded today. Open interest is the number of open contracts. Remember how I said with an options contract, you have to specify 2 open? So if you specify a 2 open order, what that does is it increases the open interest. When you specify 2 close order, what that does is it decreases the open interest. That's all it is. Can you give us a good book to look up the role of a market maker in an options transaction? Great question. I don't think that book exists. I certainly don't know of one. And I don't know that anyone is interested in writing that book either, to be perfectly honest. Is it unrealistic to think that I can take profits before a week to expiration? No, I don't think so. The only question is what price you can get. There's certainly no reason that you can't take profits before a week to expiration. Why is it called a debit spread? It's called a debit spread because it's a debit to your account. That's literally why it's called a debit spread. Is a roll 1 trade or 2? It's 2 trades rolled into 1. And I think I saw some comment about paying twice the commission. You actually pay less commissions if you trade a roll, because well, I shouldn't say that. It depends on your broker, but most brokers charge you 1 ticket charge and only charge you per contract on top of that. So if you're trading 2 trades, you should only trade 1 ticket charge. And then let's say you have 10 contracts each, then you're trading 20 contracts. So Alan, I don't know, maybe your broker is a little different. That is very possible. If that's the case, then it doesn't matter, to trade a roll or 2 separate trades, you're paying the same amount. But a lot of brokers, what they do is they charge you a single ticket charge, so that if you're effectively placing 2 trades in 1 trade, you are paying less in commissions. But the other reason that you want to trade a roll in a single trade is so that you never are exposed on one end, because you don't want to close out a position and not be able to open up the next one until a certain amount of time. You have some exposure in between those orders. So the point of a roll is to make sure that you effectively are able to roll the contract from 1 month to the next seamlessly in a single order, so you're never left exposed, because you never want one side of the order to get filled and the other side not to get filled, because then you can have some extra exposure or lack of exposure result of that. So that's why you want to place a roll in a single trade. Do your risk management rules apply to credit spreads? No, they do not, because credit spreads, you're risking more than the credit that you receive. So we actually have separate rules for credit spreads than we do for debit spreads. And when it comes to credit spreads, there are a lot more rules. It depends on each individual type of strategy. For debit spreads, all debit spreads have the same rules. So that's part of what makes debit spreads a little easier, especially for those of you that are newer, starting with debit spreads, a little easier to learn how to manage than credit spreads, which have a lot more rules and a lot more things to think about. Do we need to call the brokers for rolling? No, you should be able to place those orders electronically. You should not have to call a broker to roll your position. Now, some brokers don't offer multi-leg options. That's a whole different story. If your broker doesn't offer multi-leg options, then you won't be able to roll, and you're going to have to trade those separately. Preet, I'm really glad. So Preet, said that he was new to options a month ago. And after taking your webinars, I've already used the short puts, which expired worthless, and made money and bought long calls, which are already in good profit position. Really appreciate your help. You're very welcome. I hope many other people here on this webinar can take some inspiration from Preet to take that and options trading is something you're not going to pick up by watching this one webinar. I will tell you that. It's something that takes time. It takes time to go through education. It takes time to practice. The Montreal Exchange has really put together, I think, a fantastic package for you guys to get access to the education for free, get access to the platform for free. For those of you that joined us during the Options Education Day, there are trading simulators that allow you to simulate options trading. I highly recommend that you sign up for this if you don't already have access to. It's completely free of charge and allows you to see how you can place trades, simulate them, view them without risking any real money so that you are familiar with placing orders. A great way to practice opening transactions, closing transactions, see how your positions do before you execute them in your real account. So these are all available to you completely free of charge. So please make sure that you are able to utilize this stuff, especially for those of you that are new and learning. And half of you are saying that you're brand new and you're learning. Alan, thank you too. I really appreciate you telling me that as well. Alan said he's 10 trades over the last 10 days because of your webinars. Fantastic, that's great. Just be careful, Alan, especially if you're new. Start small, make sure that you start small, a few trades, make sure that you understand what you're doing before you immerse yourself in a lot of different trades. Because sometimes when you have too many trades, you lose track of what each one does, and sometimes that's when you can get yourself into a lot of trouble. Or if you have a lot of trades that all expire on the same day, all you need is one massive sell-off in the markets and it'll wipe out 20 positions. So be careful. Just cover calls and cash secured puts are a great start. So what's the significance of open interest? I would argue it really doesn't provide a lot of information other than the fact that a lot of people are trading this particular stock, right? So it's not, I don't think it's a surprise to anyone that there are lots of people interested in trading BMO stock, whether it's speculators, whether it's people trying to hedge their risk, whether it's selling cover calls or cash secured puts. It's a very popular stock, so you have a lot of open interest. On less popular stocks, there are less open interest. It's a good way to tell you whether there's interest in the underlying name, but again, make sure you differentiate between interest in a specific strike versus interest in the whole name. So if you look at the open interest across the entire chain and you see there's very few open interests, then there's very, very little interest in this particular name. That means that likely you're going to have to pay the sticker price or close to the sticker price. When something that trades very often like BMO, you don't have to pay sticker price because there's lots of people transacting in it. Eventually you'll find someone who's interested in interacting at your price. And plus the bid-ask spreads, generally speaking, are pretty close to each other, but still that doesn't mean that you should pay the sticker price. Open interest would reflect institutional participation, would it not? Absolutely. I mean, it reflects everyone's participation, institutions, retail, everyone. That's the point of open interest. But isn't open interest important when you're looking to close your position? Not at all. From a market maker's perspective, I don't care if there's 0 contracts or 1,000 contracts or 1,000,000 contracts. You want to close your 2 contracts, I will close your 2 contracts and I will go on the open market and buy or sell my 100 shares in order to close your 2 contracts. It doesn't matter whether there's 1,000 open contracts or 0 open contracts. So again, I'm glad that you guys are asking this question because it's a important myth that I want to bust, because it's not true that because there's 0 open interest or very low open interest that you're going to have a tougher time getting out. So this person who owns 5 contracts of this May $73 call option is not going to have any tougher time getting out of his trade than the person who owns the 72 contracts where there's 110 contracts. A market maker does not care how many contracts are open historically. It just doesn't matter. Hi, Tony. Can we use the open interest to imply the resistance and support of the underlying stock? That's really where you're getting into. In theory, if there were, so for example, in this particular case where there are 22,000 contracts and 14,000 contracts at 110, there are some market structure things that do come into play depending on whether this person is long or short that 110. But this doesn't become a problem until the stock is actually trading near it. When something is this far out of the money, that really has no influence whatsoever. I will say that there are some influences that will result when there's a lot of open interest around a certain, so let's say June comes around, and these aren't significant enough numbers, but if let's say this was 50,000 contracts at 74, that would provide some level of buying or selling around this number, because market makers that have the $74 call option would have to buy or sell stock as the stock went higher or lower. And certainly people who are maybe sold this $74 call would be more inclined to close their position because they're about to expire in the money. But that only happens near expiration. I'm talking about within the last day of expiration. Arguably not even the last day, arguably just the last few hours or the last few minutes going into trading. If there's a high amount of open interest at the money, then you will get a lot of buying and selling. And what ends up happening is that you tend to get pinned around where there's high open interest. There's some of that market structure, but again, that only comes in when there's thousands and thousands of contracts. When you have a few hundred contracts, it doesn't really matter. On my trading platform, to order put credit spread, it's always asking sell to open, covered or naked. What's the significance? It really comes down to margin requirements, whether you're selling something covered or naked. You don't get to actually choose that because it's either covered or it's not. I don't know how your platform works, to be perfectly honest. I would call your broker to ask them to specify, because I don't believe that you can choose covered or naked, because it's either covered or naked. It's not really a choice per se. Whatever makes sense to purchase an option on a US exchange over a Canadian exchange, or is it simply a case of if I want to have dollar or CAD? Again, I tend to find that the banks, the Canadian banks and the Canadian energy stocks tend to be more liquid on the Canadian exchanges. The weed companies or the marijuana stocks also tends to be more liquid on the Canadian exchanges. I do tend to find that anything else on there, you will generally find a little bit better liquidity on the US exchanges. What's your view on Air Canada? Wallace, I don't have a particular view on Air Canada per se, but my view on the airline stocks in general is that it's not great. I wouldn't go out there and buy these stocks myself. I'm only interested at this point in selling some puts when things get really oversold. I'm not really that interested in owning these stocks long-term just yet until we start to see international unless we see some visibility into when international travel will resume. At this point, it doesn't seem like that will really happen within 2020. I think that you're really looking at the very tail end of 2020 and very early end of 2021 before international travel really resumes. And I'm not a big fan of airline stocks until that happens. What's the difference between roll up and roll out? The only difference is really whether you're changing expiration dates or if you're changing strike prices. Roll up is when you're just changing strike prices. Roll out is when you're changing expiration dates. You could trade up and out, which means you're changing the expiration date and the strike price, but that's really what that means. Can you give us a good book to look up in the role? Again, I don't know of a good book on the role of a market maker, and I'll be honest, I don't think it exists, and I don't think market makers really want that information out there. I think they prefer to be kind of this in the dark, behind the scenes thing, if you will. I mean, if you think about high frequency trading, I don't think high frequency traders, generally speaking, are out there being like, hey, look at me, here's what I do. I think they prefer to be kind of very much in the background where people don't really know what they do. Do you have a simpler way to remember the difference between credit and debit spread? Yeah, it really just depends on whether you're collecting a credit to trade the option, or if you're paying. So if you're paying, it's always a debit. If you're collecting a credit, it's always a credit. I don't know how else I can delineate that, Dean. It's a good good idea to trade options in a TFSA account? I'm guessing a TFSA account is some type of a retirement account. I'm not familiar. You know, I generally find that in any type of account where it's tax deferred and you have limited amounts of capital that you can deploy into it at any year, at any given time, you generally want to avoid strategies that will require you to place large debits. So generally speaking, you want to service cover calls and cash secured puts, where you're never really in a position where you have to post a lot of or deposit money in order to maintain a specific position. So that's my take there. Okay, so many questions here. Wow. I'm going to try to get to all your questions, but unfortunately, I won't be able to answer all of them. There are just simply too many questions, but I will try to answer a few more before we log off here. I understand that you're saying about open interest on a single option not impacting liquidity, but what about volume? Same thing. I mean, volume has nothing to do with what liquidity. Again, you know, a market maker doesn't care if someone today trades 10 contracts or 1,000 contracts. When you say, I want to buy 2 contracts or 10 contracts or however number of contracts, the only thing he's asking himself is, once I sell this person these 2 contracts or 10 contracts, will I be able to buy the stock or sell the stock to offset the risk of these 2 contracts or 10 contracts that you're trying to buy or sell? Doesn't matter what anyone else is trading. So decouple that. I hope that this is enough information for you guys to decouple what someone else is trading, what other people have traded versus what you are trying to execute. Focus on what you are trying to execute. And remember, you get to choose what you want to pay. Just don't worry about what the list price is, right? You get to choose with the limit order how much you want to pay. The list price of this 68.5 call option is $1.42. But guess what? You don't have to pay $1.42. You can put in an order. You can put in an offer. You can say, I want to pay $1.35, $1.37, $1.38. Pay what you want to pay. Don't worry about what other people are trading and what other people want to trade or how many contracts other people have traded. If there are lots of open interest, that's the only thing that you need to know. Don't worry about the specific expiration date or strike price. Again, open interest and volume. Well, naturally, if there's high amounts of open interest, there will naturally be high amounts of volume. You won't see something with high amount of open interest and no volume or vice versa. So the two go hand in hand. But again, if there's plenty of open interest across the board, or if it's on this list, you know that there's plenty of liquidity. We've already gone through all this whole exercise for you on this list. Okay, so I've really tried to answer as many questions as possible, but unfortunately I won't be able to finish all of them. But again, thank you so much for taking the time out here this afternoon and participating. I'm so glad to see so many of you were able to make it to the Options Education Day. That was a fantastic event. We want to put on more events like that for you guys. So the fact that you guys all showed up and you guys all asked for the recording is really good for the TMX. They love seeing that, and that's what they want to see in order to continue that program. So they're very happy, and I'm really glad that we're going to be able to continue doing that program for you guys. So thank you so much. I hope that you guys are able to take something away from this and utilize this in your trading. So please make sure that you sign up for all the different resources that TMX has provided to you, the options play tools, the liquidity scanning that we create, the option chains, this trading simulator. These are all available to you. And again, for those of you that want to watch the recording for the TMX Options Education Day, I'll post this link again for you in the chat window so that you can take a look at the whole Options Education Day recordings at your leisure. So thank you so much. I hope you guys have a great evening, and I'll send you guys a recording for everything here in about an hour here once we finish. So thank you so much and have a great evening.